Welcome to the Deep Dive. Today we're plunging into a really significant and, let's be honest, pretty controversial topic. It's the potential integration of private equity investments right into your 401k plans.
Yeah, it's a big one. We've been looking at analyses, around potential administration policies, the lobbying efforts from the PE industry itself,
Yeah.
and also these detailed breakdowns of the challenges, especially for the plan fiduciaries.
Exactly. So our mission today is to help you understand what this shift could actually mean for, well, millions of American savers like yourself. We want to explore the promise of better returns, but also weigh that against the unprecedented challenges and risks involved.
Right.
So let's start with the bull case, the argument for bringing private equity into 401ks. It often sounds quite compelling, doesn't it? What's the core idea there?
Well, the PE industry, they really frame it around potentially higher returns and diversification. You see studies like one from Georgetown suggesting PE could boost retirement income by like 11 to 17%.
Wow, that's substantial.
It is. And Goldman Sachs put out a calculation too, saying even a modest 1% annualized return bump could increase your total savings by maybe 26% over 40 years. That gets attention.
I bet. And I've also heard this point that, the number of publicly listed companies has dropped like by half since the 90s. So PE offers access to a part of the economy you might otherwise miss.
That's definitely part of the narrative, access to growth.
And this whole idea of democratizing finance, letting average workers into asset classes that were previously just for big institutions or the very wealthy. Is that kind of the pitch?
That's exactly the pitch, leveling the playing field, so to speak. But, it immediately raises the question, at what real cost for the average person?
Well,
because when you flip to the bear case, the risks, they're pretty significant. You mentioned the fees earlier.
yeah, the 2 and 20 thing.
Right. A 2% management fee annually plus 20% of the profits. That's just worlds away from a typical 401k target date fund fee, which is often well under 0.5%.
Huge difference. And these PE fees, they can be complex, kind of hidden sometimes.
Very complex, often opaque, and they can seriously erode those returns everyone talks about.
Okay, so beyond fees, illiquidity. I've heard it called a roach motel. Easy to get money in, but getting it out, that's the hard part. Is that fair?
That's a pretty good analogy, actually. PE funds lock up your capital for a long time, 7, 10, maybe 12 years or more.
Which just doesn't line up with a 401k, right? Where you need daily liquidity for rollovers, loans, hardship withdrawal.
Exactly. It's a fundamental mismatch. And then there's the valuation issue. We call it a black box problem sometimes.
How so?
Well, these assets aren't priced daily on a public market. The fund manager values them maybe quarterly. It's subjective.
Right.
This can lead to something called valuation smoothing, where the reported returns look less volatile than the underlying assets truly are. It masks risk.
Making it tough for the people running your plant, the fiduciaries, to really assess it independently.
Precisely.
Yeah.
And look, there was a Johns Hopkins study just this year, 2024. It basically concluded large leveraged buyout funds, that's PE using a lot of debt, are, and I quote, unsuitable for 401k plans.
Unsuitable why?
High fees, the illiquidity we talked about, and importantly, they often fail to beat the stock market after accounting for those fees.
So for your retirement plan, even if PE is an option, that study suggests it might not actually deliver, and it adds risk. Which brings us back to the plan fiduciaries. They have a huge responsibility under federal law, ERISA, the prudent expert standard.
They can be held personally liable if things go wrong. So evaluating something as complex as PE requires incredibly thorough due diligence. It's a high bar.
And the rules keep changing, right? It's a regulatory pendulum.
That's a great way to put it. Huge uncertainty. In 2020, the Department of Labor put out a letter, sort of cautiously permissive. It allowed PE, but only as a component within a managed fund, like a target date fund. Not standalone.
Okay, a small opening.
Then, in 2021, the next administration issued a supplemental statement. Very cautionary. It basically said, look, small plan fiduciaries are not likely suited to evaluate PE. A real pullback.
And now, there's anticipation of a potential Trump executive order that might swing it back the other way, aiming to ease PE inclusion, maybe even offer legal safe harbor protection for plan sponsors.
That's the expectation, yeah. This back and forth, this regulatory whiplash, it just makes it incredibly difficult for fiduciaries. It ramps up the litigation risk and their burden.
Absolutely. So tying this all together for you, the listener, The impact wouldn't be the same for everyone, would it?
Not at all. Think about a younger investor, someone in their 20s or 30s, decades to go. They might theoretically benefit from potential higher returns because they can ride out the illiquidity, maybe.
But what about someone closer to retirement? Say you're in your late 50s, your 60s. How does this PE illiquidity and volatility fit then?
It fits very poorly,
Yeah.
frankly. For people nearing retirement, the focus usually shifts to capital preservation, needing access to funds. PE's long lockups and inherent volatility introduce really significant risks right when you need stability most.
Yeah, it makes sense.
And let's face it, most people with a 401k aren't, sophisticated financial experts.
Right.
They might not grasp the complex risks if PE gets tucked into their default investment option,
Right, hidden complexity.
exposing them to potential downsides,
Right.
volatility, illiquidity, right when they can least afford it.
Okay, so let's sum this up. Adding private equity to 401k.
Yeah.
It looks like a really high-stakes idea. There's this theoretical potential for higher returns.
But it's weighed down by definitely higher costs, way more complexity, less transparency, and pretty significant new risks, both for you as a participant and for the fiduciaries managing the plan.
And that regulatory picture is just volatile. Makes long-term planning tough.
Incredibly tough. It seems unlikely that widespread, safe adoption is going to happen just through executive orders. You'd need real changes in the PE products themselves, lower costs, more transparency, plus stable regulations that truly protect savers.
So the final thought for you, our listener. As this financial landscape potentially shifts, how prepared are you to navigate these kinds of new frontiers in your own retirement planning? And maybe more fundamentally, who really stands to benefit most from these changes?